While the market can develop into a neutral range at really any point, this ties into the last lesson where very commonly after a large range on the daily time frame, that expansion rule, the market ends up consolidating, finding yourself in a neutral range, which is this third caution protocol. A neutral range is defined when two things occur. The first is when you have failure swings to both sides of the market. So failure swing highs above, failure swing lows below. Just like you understand from the price signature section, you can't trade away from failure swings. So when the market has that to both sides, it becomes completely neutral. The second is once you see those failure swings to both sides, once price reaches equilibrium of these 2 points, the lowest low to the highest high, that is when you are now in a neutral range protocol. Once price hits equilibrium here with failure swings to both sides, you now put your focus to the external high and external low, and that's where opportunity exists going forward. That previous graphic was an hourly perspective, but where you're most often going to first find this is on the daily time frame, because that is your highest time frame to be starting on. You'll see that there are failure swings to both sides. When you can see that wick getting really deep back into previous day swings at the highs, at the lows, creating those failure swings. And an inside candle is another big one that really does indicate prices beginning that neutral range. And it's really worth it where you identify it on the daily, then you go and break it down to the hourly to confirm those failure swings. You already understand this from the price signature section, specifically with failure swings and divergences. But when you first identify that potential neutral range with failure swings to both sides, you want to compare it to a correlated pair to make sure they are true failure swings and not false failure swings. This would be an example where you identify the failure swings off the highs, failure swings off the lows, and it's reaching back towards equilibrium. This is a potential neutral range. But then when we compare it to a correlated pair, we can see that at that same high where we see failure swings, there's actually a protected high which could be traded away from. So this is actually a bearish biased market where we could trade into these true failure swing lows because we have a failure swing here and the same thing occurring at that same point on the correlated pair. If you go through the process and notice both sides of the market have true failure swings, then you move on with the neutral range protocol, which we'll talk about here. Just like I mentioned before, when the market is in a neutral range, we're focused on the extremes, the external highs, the external lows of that range, because that's where we anticipate opportunity to exist. And that's where the failure swings get run out. So we're waiting for one of those 2 points to be engaged and determining what to do going forward, depending on the reaction. Here is the first example, which is a classic one that most people understand and are familiar with, is when we have a manipulation of the external range to then target the opposing side. What you're going to see on the daily is that we run up into that external high or external low, and we wick that point on a daily candle. So trading up into it, manipulating, and then immediately turning back lower, closing back into the range. That is a daily signature that shows a manipulation. That would give us an initial bearish bias to draw back into the external low or the opposing side of that neutral range. We can refine this slightly on the hourly perspective if we are looking to trade the continuation day only. Here you would see a change in state of delivery. So where price opened up, traded higher into that external high, dropped lower, had that confirmation, the change in state of delivery, closing below that lowest up close candle, which drew into that high. That is the confirmation that this high does not need to be traded back to. And the following day, you would look for that continuation, that expansion candle to the opposing side of the range. This is the second scenario that we can have, is that when price reaches that external range, instead of running up into it and immediately dropping back in for a manipulation, we actually see price expand through that point, and on the daily time frame having a strong close through it. That is a sign of not a manipulation, but a continuation and a true breakout of that neutral range. Again, refining this to an hourly time frame, looking within this daily candle, which closed through the external side of this range, you can look to see if after closing above that external high, since this is a bullish example, look to see if an opposing close candle forms, and then we close back through it. That is an added confluence that this is a true breakout taking place, and that just pairs alongside the narrative and understanding that we can trade this as a continuation to the upside, understanding that's a true breakout higher. One distinction to make between the two ways that the market can leave a neutral range, like we just discussed, is that in the first example, when it's a manipulation, that can be traded either on the following day when you have that previous day close confirming that it's wicking that external high, closing back into the range and you trade the continuation. But you can also trade that intraday on the same day it makes that manipulation and reverses. That all depends on the size of the wick at that time, and you will understand what I mean by that in a very soon upcoming lesson. But with this second example here, when the market breaks out of that neutral range, this is more heavily reliant on the daily candle close this here, and it's more likely that you're going to be trading this the following day after you get confirmation that the daily candle closed aggressively outside of the range.